Understanding last in, first out, LIFO, inventory valuation method. In the realm of accounting for business inventory, the last in, first out, LIFO, method plays a significant role, particularly for U.S. businesses. LIFO identifies the most recently produced or acquired inventory items as the first sold, thereby influencing cost of goods sold, COGS, and overall financial reporting. Key concepts of LIFO. Definition and mechanism. LIFO operates on the principle that the latest items added to inventory are the first to be sold. Consequently, the costs associated with these recent purchases are recorded as COGS while older inventory costs are retained on the balance sheet as current assets. This method is especially relevant in industries with large inventories, such as retailers and auto dealerships. Comparison with other inventory methods. LIFO is one of three primary inventory accounting methods, the others being first in, first out, FIFO. This method operates on the opposite principle. The oldest inventory costs are recorded as COGS, presenting a different financial picture, particularly during periods of inflation. Weighted average cost. This method computes the average cost of all inventory items and applies this average to both COGS and ending inventory. Each method has its distinct strategic advantages and implications for a business's financial health, especially regarding taxable income and reported earnings. Advantages of LIFO. Tax benefits. One of the most compelling reasons businesses adopt LIFO under inflationary conditions is the potential for reduced taxable income. Since LIFO results in higher COGS in times of rising prices, it effectively lowers net income, thereby minimizing the tax burden. This is critical for companies facing increased costs, as it allows them to manage cash flows more effectively amidst financial pressures. Financial reporting consistency. While many public companies tend to favor FIFO due to its favorable representation of profit, maintaining consistency in reporting is crucial. If a business opts for LIFO for tax reporting, it must use the same method for financial statements, creating a streamlined view of financials for stakeholders. Limitations of LIFO. Banned globally. While LIFO is permissible under U.S. generally accepted accounting principles, GAAP, it is banned under International Financial Reporting Standards, IFRS. The rationale behind this restriction primarily focuses on minimizing taxable income, which is disfavored by regulatory bodies in many countries. The concern is that LIFO can lead to inflated earnings when used consistently over time. Inventory valuation concerns. LIFO can significantly underestimate the value of inventory on a balance sheet, particularly when prices are continually rising. This discrepancy can misrepresent a company's financial health to investors and other stakeholders. In periods of deflation, LIFO presents lower COGS and consequently higher net income, which may appear misleading during a downturn. LIFO in action. To illustrate LIFO's cost implications, consider a scenario where a company has 10 widgets. Suppose 5 widgets cost $100 each, and another 5 cost $200 each. If the company sells 7 widgets utilizing the LIFO method, the COGS would total $1,200, 5 at $200 plus 2 at $100. In contrast, if FIFO were employed, the same sale would result in a COGS of $900, 5 at $100 plus 2 at $200. This difference exemplifies how LIFO can create higher costs and lower reported income during inflationary periods. Which method is better? Deciding between LIFO and FIFO often hinges on the specific business context. Inflationary environment, LIFO often provides greater immediate tax relief, making it attractive for businesses whose operational costs are on the rise. Investor relations, for public companies, showing higher net income via FIFO may strengthen shareholder confidence, while LIFO might raise concerns about profitability. Ultimately, the best method will depend on a business's inventory management strategy, financial goals, and market conditions. Conclusion. LIFO serves a specific niche in inventory accounting, predominantly benefiting companies facing inflationary pressures by enabling tax advantages and cash flow management. However, it is crucial for businesses to weigh these benefits against the potential drawbacks, such as lower net income and regulatory scrutiny. As the global accounting landscape continues to evolve, companies must remain informed about how their inventory valuation methods impact their financial statements and investor perceptions.